Buying your first house is a big commitment and can feel very overwhelming. I think back to when I bought my first place. I was weeks away from becoming a father, and my landlord told me I needed to either buy the place or move out, so I was left scrambling. We literally signed the papers for our new place, and the next day my oldest son was born. So that was a bit of a stressful situation. Your situation may not be that stressful. I hope not. But I also know that at that time, I wish I would have had somebody that would have helped me walk through the process of buying a first house, everything I needed to consider. And so with that in mind, I'm making this video for you so that you can have that help along the way. My name is Jeff Magdalene. I'm a realtor here in Windsor, Essex County in Ontario. And if you are looking to buy your first home, or you know somebody that's looking to buy their first home, please share this video with them, comment on it, like it. It'll help give it that extra boost on the algorithm and get it out to more people who could use the help. If you are not in the area and you are looking to buy your first house, hopefully a lot of this stuff still applies. But if you're looking for a good realtor, I make it a huge priority to get to know other realtors through the events I go to, the conferences I go to, social media, all that kind of stuff, so that if you need a realtor anywhere in Canada, the US, please reach out. My email, as always, is in the description. If you have questions regarding this video, or if you are looking for a realtor in your area, please use that email, reach out, and I'll be happy to get back to you and help you in any way I can. Okay, so you're looking to buy your first house. Like anything else, you need a plan. You've heard the saying, if you fail to plan, you plan to fail. It is the same with buying a house. Yes, I will acknowledge it is getting harder and harder to buy a house these days, but if you have a plan, it gives you that edge. And if you're watching this video, chances are you believe that it's still possible as well. So I'm going to provide as much value as I can for you here, get you going on the right path, and let's see if we can get you into that first home. The first step in purchasing a house is you're going to need to save up for a down payment. Some may argue is you need to get pre-approved, but if you don't have any money put away, there's no point in getting pre-approved. So let's talk about how you put money aside for a down payment. There's a few different accounts that the government has come up with here in Canada for this. The first is the first-time home buyer's savings account. Now this is very much like a tax-free savings account. It operates very similar, but it's for the use of buying your first house. So you get to put away up to $40,000, which is good for about a $650,000 house. In our area, that is above average home. Most people aren't buying that for their first house, so you don't necessarily need to put away $40,000, but the option is there. And if you can finance a $650,000 house for your first house, that's great too. That's totally up to you. But $40,000 over the course of 5 years. So you put $8,000 away, and let's say the first year you can only put $7,000 away. The next year you can put $9,000 away. But if you only put $7,000 the next year, you can't keep rolling it over. It only rolls over 1 year. So you need to keep it up to date every 2 years or so. So that's the tax-free savings account. It also is tax deductible, so it's coming off your income. You pay less taxes. It grows interest-free. Sorry, the interest is tax-free that it grows with. And when you pull it out, you're pulling it out tax-free. So like I said, very much like a tax-free savings account. And again, you can get up to $40,000 over the course of 5 years. And there's no age at which you have to start this. So if you're a 15-year-old kid that's, living at home and has excess funds that you can put away, that's a little bit of money that you can start at a young age putting it away, so that by the time you get to college, it's sitting there, or even by the time you finish college, it's sitting there ready for you when you're ready to buy your first house. So that's one option, is the tax-free savings account, or the first-time home buyer savings account, which, like I said, operates like a tax-free savings account. The second one is RRSPs. Now, RRSPs, you can borrow from them. Basically, you're loaning yourself the money, and you can pull out up to $60,000. Now, again, that's already going to be much more than you probably need for your first house, especially in our area. If you're in a bigger city or a place where the average cost of a home is much higher, you might need that $60,000. It's also $60,000 per person. So if you are buying this with a friend or a partner or your spouse, then you can each take out $60,000. So you'd have $120,000 that you could put towards the down payment. Now you have up to 15 years to pay that back. So you have time to put that away and get it back. There's some grace period in there for about 5 years, but within 15 years, you need to get that paid back, and that you're paying that back interest free. So again, it's like giving yourself a loan where you're not being penalized by having to pay interest on that loan. The last thing you need to remember with a down payment is that when you go to buy a house, you've probably heard that it's best if you can do it to put down 20%. Now, 20% is probably difficult for a lot of people buying their first home, but if you can do it, then you can avoid paying what's called CMHC. Now, CMHC is basically, there's two types of loans when you are buying a house. One is an insured loan, one is an uninsured loan. An uninsured loan is when you pay 20% because the lenders take you as a low-risk client, and they believe that you're going to be able to pay your bills, and because you've been able to put 20% down, and so they're not worried about you defaulting on the mortgage. If you are under 20%, you are considered a high risk, which sounds a little bit aggressive, but most people are putting less than 20% down, so don't feel bad. And so with that higher risk, the bank or the lender is going to take out an insurance policy that says if you default on your payments, they're going to be covered for this. And they're not people that are just generous. They're not going to pay for that insurance policy themselves. They're going to pass that cost onto you. So if you are putting under 10% down on a house, you are going to have to pay 4% of the purchase price as CMHC. From 10%, anywhere under 15%, you're going to pay 3.1% of the purchase price. And anywhere from 15% up to 20%, you're going to pay 2.8% of the purchase price as CMHC. It's also going to get rolled into your mortgage and is going to be financed like your mortgage. So it's actually going to cost a little bit more over the course of your mortgage. If you can get to 20%, that's great. Most people can't on their first home, so don't feel bad. Put down what you can, put down what the minimum down payment is. Let me just explain how the down payment works. So on a house that is up to $500,000, you will need to pay 5%. So that's going to be $25,000. Once you get to $500,000, anywhere between $500,000 to $1.5 million, it is going to be 10% of that amount. So the first $500,000 is 5%. If you buy a $700,000 house, that's $200,000 more than 500. You're paying 10% on the 200,000, not the 700,000. So it'll be another 20,000 plus the original 25,000. That's 45,000. That's why I said before, if you do the math, $40,000 from the first-time homebuyer's account is going to get you a $650,000 house. Last part in talking about getting your down payment is just straight up saving. I always say create a budget. The younger you can learn to create a budget for yourself, the better off you're going to be in so many areas. I started at a young age and I realized two things when I started to budget. One, I spent my money in a lot of stupid ways, and so I learned that I had more money when I stopped spending it in stupid ways. And two, I found that I could be more generous when I budgeted where my money was. So not only did I refine my spending a little bit, but I was also be able to give to charities, give to people, give to other things, and still be saving and doing the things that I wanted to do with my money. So it was a really cool experience just to budget and put it away and just see where your money's going. When you actually take a look at what's going out and what's coming in, you might look at some things and you're like, do I really need that? When so often it's so easy to click a button, tap something on your phone, tap the credit card or whatever, debit card, and money goes out and we don't even feel it. But when you take a look at it, when you're writing it down every day, it's like, do I need that? That is a great way just to track all that and say, maybe I need to stop doing that as much. Maybe I don't need as much Starbucks. Maybe I don't need all those subscriptions. Something to consider, take a look at it, know where you're at. The last suggestion I will give you is what I mentioned before. If you are able, you're still living at home and you're not paying rent anywhere, if you are able to put money aside and basically pay yourself rent as kind of a savings, that is a great opportunity because housing is going to be one of the biggest line items in your budget going forward for the next several years. And so if you can take that and start to do it before you actually have it, then one, it's already going to condition you to budget a life of having that as a line item. And two, it's going to help you put money aside for your down payment. So it doesn't have to be a massive amount. And again, if you need to save up, if you know you're a few years out, you're in college still, or maybe in high school, or even just got out of college, and you might be a little ways away from buying your first house, $8,000 a year that you can put in your first-time home buyer savings account works out to roughly just under $700 a month. So if you got that extra money, which is way cheaper than renting anywhere else, so thank your parents for letting you stay with them, and pay yourself that rent. You can do it faster if you want, but that is just one option of how you can do it. The next step in this plan is you need to go get that pre-approval. So first we talked about saving for the down payment. Now this is what most people will tell you is the first step. Go get a pre-approval. Now, a lot of people are nervous about going to get a pre-approval and shopping around because they're afraid that it's going to affect their credit. I would say it is in your interest to see what the best product is out there as far as mortgages and your situation. So I highly recommend talking to a mortgage broker. They're going to be able to talk to different lenders and have a few more options for you. And they may very well put you back with a bank. They might put you back with a TD or a Scotia or something like that. But if you want to go that route, they can shop around and go to battle for you and negotiate on your behalf. Now, that being said, RBC and CMHC do not have a brokerage division, so you won't get put back with either one of them if you go through a mortgage broker. So if you want to talk to them independently of your mortgage broker, that's an option too. See who can get you the best deal, see who can get you the best product. I'll let them explain what all those things are, but you have to think about, if I'm only holding this house for 2 years and then I'm going to move again, that might affect what kind of mortgage you get, those types of questions. So if you have questions about that, you can email me, but those are the three I would say is talk to CIBC, talk to a mortgage broker, and talk to RBC. I've had great experiences with all three. Once you have your pre-approval with a lender, this is going to give you a map. It gives you that budget. You can start looking around at what is going in that price range, gives you an idea of what you can afford instead of going out shopping, finding a house you love, and then realize it's $100,000 out of your price range. You don't want that disappointment, so get that map before you start getting out shopping. The next thing is you need to consider what kind of mortgage you want. Again, your mortgage broker will explain this a little bit more detail, but I'll just explain kind of how it works. There are fixed mortgages and there are variable mortgage. A fixed mortgage is basically you're going to go in and they're going to give you anywhere usually from a 3 to a 5 year term. Typically it's 5, but it can vary anywhere from, it can go as low and high as you want. You're just going to pay different rates for it. But let's say for the sake of this video, you're going for a 5-year fixed mortgage. When you do that, the mortgage rate you get will stay fixed. It is not going to change for the next 5 years. So when you hear mortgage rates are going up, mortgage rates are going down, if you're in the first year of mortgage, you probably don't have to worry about it. Second, third year, probably don't have to worry about it because your mortgage isn't going to change. As you get close to renewal, which is basically when those 5 years are up, that's when that's going to affect you a little bit more because there's going to be a new rate and your mortgage payment could go up or it could go down. Variable rate mortgage, same thing. You can lock into the next 5 years. You could do a 3-year term, whatever. But again, for this video, let's say you're doing a 5-year variable. 5-year variable will just mean that your payment or the amount you're paying will change as interest rates change. So your payment, it's a little bit more of a risk. If rates are really high and you think that rates are going to go down, then it might be a good idea to get variable because you could pay less over the next 5 years. There's always some risk involved. Anything can happen, right? So you have to discuss that with your mortgage broker. I think a lot of first-time home buyers are more comfortable going fixed just because they want to know the budget and then they can plan for that. But that's completely up to you. Just know that when you talk to a mortgage broker, that might be something they ask you about, which you would like to do. Have them explain a little bit more detail, but that gives you just a quick general sense of what that's all about. The next thing I want to share is amortization. I didn't explain this before, but when we were talking about CMHC, if you put down 20% on a house, you can also amortize your house over 30 years instead of normally what it is 25 for buyers that are putting down less than 20%. Now, if you amortize out longer, your payment is going to become lower, but you are also going to pay more interest over the term of 30 years than you would the term of 25 years. So you have to decide, okay, what is it? Do I want to pay a little bit less now and more in the long run? Or am I comfortable paying a little bit more now and get this thing done in 25 years instead of 30? Now you might be thinking, well, I'm not putting 20% down. First-time home buyers, they have changed the rules for that for you as well. If you are a first-time home buyer, you are now allowed to amortize up to 30 years without a 20% down payment. So you can put the minimum down payment and you can amortize over 30 years. So again, talk with your mortgage lender about this, get a schedule of payments, see what they look like. You can always change it. If you decide to move several years down the road and you want to change your mortgage back to a 25-year, you can do that. You can tighten it up. You're making more money now. You're in a better position financially. You can do that. So that's an option for you as well. The 30-year amortization is going to give you that lower payment. You're going to pay more in the long run. 25 higher payment, but you're going to pay less in the long run. Completely up to you. The final thing you're going to be faced with when you go apply for your mortgage is the stress test. So the stress test basically says whatever the rates are, they're going to approve you for a mortgage that is 2% higher than whatever the current rates are, or 5.25%, whichever one is higher. So if interest rates are 2%, they're going to stress test you at 5.25. If interest rates are 5%, they're going to stress test you at 7%. The reason they do that is so that, like we've had in the last several years, when interest rates shot up, it shows that you can afford those payments even if rates do go up. So all those people that were on variable that got pre-approved or got a mortgage at 2% and they went up to 5.25 or 5.5, it just showed that these people should be able to afford that. Now maybe they couldn't because everything else in the world is expensive, but that's the reason we don't have major defaults in this country and why we didn't have merely the problems we did in 2008 that the US did. Banks have been stress testing people for a higher rate than what they are getting when they get their mortgage. So just be aware of that, and that will be, again, something you discuss with your mortgage broker. All right, you got your down payment, you got your pre-approval. Now's the fun part. You get to go shopping. This is where you're going to need a realtor. You're going to start looking at some houses. You're going to probably already looking at realtor.ca or whatever to find houses, but this is going to be your opportunity to get out there and see some houses. First thing I recommend when it's time to go shopping for your first home, talk to your parents or your aunts and uncles or maybe even your grandparents about their first home. Most people have a story of some just ridiculous home that they lived in for their first home. Most people don't walk into the picture perfect forever home, the home maybe you're living in now. And so it's going to feel probably like a little bit of a step back. But here's the thing, it may be a step back from what you're in now, but it's going to be yours. And so there's something special about that. I remember talking with a couple one time where we were in a room in their house, and it was not that massive of a room, but a good sized room. And the wife was telling me their first house together was smaller than the room that we were in at that moment. And the room that we were in was inside a house that would eventually sell for over $3 million. And so obviously they did well, they were successful, and they were able to move up. You might not ever live in a $3 million house, but your first home isn't going to be your forever home. So when you go out looking for a home, you need to think, what am I willing to deal with for now? What am I going to work with? What can I, you're going to find some things after you live in a house for a while and say, I would do this again, I wouldn't do that kind of thing. But what kind of work? Usually for first-time home buyers, you're at a lower price point, the house isn't perfect. What kind of work are you willing to do? Paint is the easiest thing in the world. If it's just ugly, paint it. A few $100, grab some friends, get together, paint it up, you're good to go. If there's major structural things, if there's things that are going to cost a lot, then you might want to consider, okay, do I have the funds to take care of this? Is this something that I want to deal with now? Or am I going to look for something that maybe is a little bit more suited for what I can handle? What are the big things you should look at? The roof is a big expense. Windows are a big expense. Your HVAC, so your furnace and AC, how old is that? That's supposed to be about 20-year shelf life for those. Sometimes the ones that are older work great, they last forever. They may not be as energy efficient, but more and more now they are. So you just have to see what kind of condition, have they been taken care of? Are people keeping up with them? So that's another one. windows, HVAC, roof, plumbing, electrical. Plumbing, the big one I would mention there is a product out there called Kitech, and that was used in the early 2000s. So if you are buying a house that was built around that time, it may have that product in there, and that's something that insurance companies tend to not like. You can get it insured, but it could become a problem, and so they may ask you to remove all that, which isn't necessarily a massive cost. But if everything is drywalled in, then opening up the drywall is going to get costly when you have to patch all that afterwards. So if you have a basement where it's just a ranch style home and the basement roof isn't finished or ceiling isn't finished, and you can pull the plumbing out and push it back through, that cost isn't astronomical, but it is something you're going to want to consider. Electrical, if you're buying a much older home that had knob and tube wiring in it, you see that around Windsor. We see it all the time here. It's not necessarily active all the time here, but I still see remnants of it. And that is something that was used 100 years ago, 80 years ago. And that's something, again, insurance companies don't like, so they'll want you to replace that. Some insurance companies have an issue with aluminum wiring. They're going to want to know that and make sure that it's inspected and working well and not prone to arcing and causing house fires. So those are the two things that you're going to want to pay attention to when it comes to electrical. So those are some of the big things. Foundation is also going to be a big thing. If you get into a basement, is it waterproofed? Is it leaking actively? Are there any major cracks? Anything like that? Those issues can be very big and expensive issues as well. So those are some of the big things that I would look out for when I'm looking at houses, not just how cute is it, what color are the walls, what are the floors like. All those things are going to matter, but those are the big things you're going to look for. Again, ask yourself when you're going through your house, what can I change? Something like paint, very easy to do. There are things that you can't change. One is, you always hear this in real estate, location, location, location. Not just what part of the city you're in, or even if you're in the county, but what's next door? Who is next door? It's crazy to me the amount of money we're spending on houses nowadays, and people don't knock on the neighbor's door or knock 2 doors down and say, what are these people? What are your neighbors like? Because you can move in next to somebody that you don't get along with, and now you're stuck there. You spent a lot of money to live next to somebody who annoys you. So that can be something that you might want to do. But maybe there's a school next door. Maybe like my first place that I rented had a cemetery next door. And now, that was no big deal to me. I thought, quiet neighbors, that's great. But when I try and sell houses, many people are like, I don't want to live next to a cemetery. It may be a stigma thing. Some people just find it weird, but people don't want to do it. But that can change from area to area. I know there are people in Toronto that would love to live next to a cemetery because they know that a massive condo building isn't going to go up right next to the house because there's a cemetery there. So you have to realize all these things when you're buying a place. What's around you? What part of the town or city are you in? And how does that impact your house? How is that going to impact you living there? And how is that going to impact your ability to resell that home when you decide to move on? Some things that are good to know that I would ask your realtor when you're out shopping for a house. One is, what kind of market are we in? Is it a buyer's market? Is it a seller's market? Is it fairly balanced right now? That's going to impact your pricing strategy or your offer strategy when it comes to writing an offer. So that's something you're going to want to know. And it's going to also teach you probably how quickly you need to move and how aggressive you need to be. So that's good to know. When you're out looking at houses, how many days on market has this house been? Has it been listed and then taken down and relisted again? It may say it's only been on the market for 7 days, but you saw it like 3 months ago. It's because they took it down, relisted it, tried to re-engage and get people attracted to it again. Or maybe they tried to list it low, drive up offers, and it didn't happen. So they took it down and listed it again, vice versa. There's all sorts of different reasons, but just know how many days on market has it been. The longer it is, you might be dealing with a seller that's difficult, or you may be dealing with something where there's something wrong with the house. But those are things you're going to want to find out. Last is, how much inventory is there out there? Basically, you're going to look at how many houses sold last month and how many are on the market right now, and that's going to tell you how many months worth of inventory. As that number goes up, that's going to tell you if you're in a buyer's or seller's market. And those are things that you're going to want to know, because it's just going to give you it's going to give you like what you need to know and how you can feel about this. Like if in the seller's market, you're probably going to need a little bit more urgency. If you're not in a seller's market, you're in a buyer's market, there's less urgency. Are you at a time of year where maybe you don't need to be as stressed out? So I always used to tell people when we saw the market spike up, that was typically in the spring for us. But then once you got to like June, July, yeah, prices were high, but if you didn't get a place that you liked, you lost out on an offer presentation, another house would be out like that the next week, and it would be the same price. In the springtime, if you missed out on one and you didn't get it, that same house is probably gonna be $5,000 more the next week. Like it was nuts. So knowing these things helps you stay in control, helps you keep calm, and helps you make better decisions. I would also recommend asking your realtor to show you what has sold for the price that you are budgeted for. Gives you an idea what you can get, and even just looking at it on the computer first before you get out and looking at houses. Look at what's already sold in your budget and get an idea like, I would like this, I wouldn't like this. Those help refine things and make the whole shopping process a lot quicker and smoother for you as well. Last thing I'll say, quick tip, just when you go through a house, I ask especially first-time home buyers this, what is your Google review of this house? Usually when you visit a business or work with a service and you want to give it a Google review, a lot of companies want 5-star reviews. You can find a pretty good house that maybe it's only 4 stars. 5 stars, yeah, you know you want it. 4 stars, it's probably a pretty good house. I might be interested in that. Anything under 4 stars, if you wouldn't give it a 4-star Google review, I'd probably be patient. Because listen, buying a home is not like buying a investment property. It is emotional. It is your home. This is where you're going to live. And so how you feel in the home does matter. How it makes you feel, the comfort level you feel in the home, all these things, it's not just, does this financially make sense? Can we afford it? A lot of times you want it to feel like a home as well. So take those feelings into consideration. It's not just about what we can afford. It's not about budgets and down payments and all the practical things. It's also an emotional thing. And those emotions have a role in this as well, and they are valid as well. So consider that when you're out shopping as well. All right, you've seen enough houses, you've found the one, it's time to make that offer. This is the next step in buying your house. Now, when you write an offer on a house, you're gonna do this with your realtor. What I should mention is when you start working with a realtor, stick with one realtor. I would highly recommend this to anybody. A lot of people want to go with the listing agent because they feel like they're going to get some sort of deal. The listing agent works for the seller. And so their job is first to the seller. And if the seller gets more money, the listing agent also gets more money. So it's in the best interest of the seller, the selling agent, to lean towards the seller, which they shouldn't do. If they're going to represent both of you, they have a duty to treat you both fairly. But I would say find somebody that's going to walk this journey with you. Somebody that's going to know every house you looked at, get a sense of what you really like and what you don't like, and walk through it with a realtor that's going to be your person in your corner on your team and help you get the house that you want. So that when you get to the offer portion of the house, you have somebody that is negotiating hard on your behalf. Now, there are plenty of things that consider when offering on a house. Price is one of them, obviously. That's the big thing that the seller puts out there. But there might be other things that really motivate the seller. Deposit is something so a deposit is different than a down payment. A deposit can be part of the down payment, but when you put an offer in on a house, they're going to ask for a deposit that goes with the offer. Usually it gets put in our area after an offer gets accepted, but then it's due within 24 hours of your offer being accepted. So you do need to have that cash on hand. For first-time home buyers, I would say likely going to be in the $5,000 to $10,000 range. But again, that can come out of your down payment. So like you don't need the $40,000 plus another 5 to 10. That comes out of that. So as long as you have that cash readily available and liquid that you can submit it for your offer, that's great. The other thing that you would have is, so you have your price, you have your deposit, you also have your possession date or completion date. This will have an impact with some sellers. Usually on any listing, it'll say what their preferred closing time is. There could be a range, there could be a specific date, but if you can get as close to the specific date that they would like, a lot of people have one in mind, You're a first-time home buyer, so you have a little bit more flexibility. So if you can be flexible with them, it can give you an edge over somebody who also may be offering on that house that already owns a house and needs to sell theirs and needs to line up their closing date, and it all needs to work out on, you don't have that issue. So if you can line up with their closing date, it's going to be easier for you. The other big thing that I will mention here is conditions. Now, there's been 4 that are typically included in an offer historically. One is financing. So financing, 2 things about finance, or there's 2 parts about financing. One is knowing that you are able to pay what you are offering the house. That's your pre-approval. So we already know that's one part of the financing condition. We already know that part's good. The other part of it is the appraisal of the house. Is the house that you're buying worth what you're offering on it? You may be approved for $1 million and offer $1 million on the house, but the house is only worth $500,000. The bank's not going to give you $1 million to buy a house that's only worth $500,000. They're going to give you $500,000 to buy $500,000. So if you offer $1 million, you're going to have to come up with another $500,000 yourself. Now that's an extreme example, but let's say you offer on a house you offer $475,000, and the bank comes back and says that house is only worth $450,000. Where's that other $25,000 going to come from? It's going to have to come from you. So if you put a condition in your offer that says this offer is conditional upon financing, and that happens, you've offered $475,000, the bank says only $450,000, you don't have the $25,000 back, you don't get approved for financing, you get your deposit back, and you've been protected. No harm, no foul. So that's why you put that condition in there. The next one would be a home inspection. I highly recommend you always get a home inspection. You want to know what you're buying, have a look through, know what's going on in and around the house. It's worth the price of whatever you're going to pay for that house, for that inspection. House to sell is a typical condition, but you don't have that. You're a first-time home buyer. And then insurance on the property, which typically isn't an issue. I've never had to include that, but that's historically been one that has been included in offers as well. When you do offer on a house, there are many different ways it can go. You might be in a multiple offer situation where you got to come in with your highest and best, and it might be over the asking price. You have to know what the situation is. You might put in an offer and you say, well, we wouldn't want to pay more than this for this house, and it's much lower than what they're asking. You can still put that offer in. They could counter you back, and that's where it becomes a negotiation. So you need to know where you're at and where the market's at, because if it's a buyer's market, be willing to shoot your shot. You want to pay a little bit less, you don't know what situation the seller is in, and maybe they're willing to take a little bit less. If it's a seller market, get ready to sharpen your pencil, because you're going to have to pay a little bit more than what the list price is, because you're probably going to be in a multiple offer situation. But if you know your comps going ahead, you're again having a realtor that knows what they're doing, that knows you, they're going to be able to show you what they think this house is worth. And then when you get in a multiple offer situation, you know what to offer. So when you put an offer in, you can either get countered where they come back at a different price. They can say, yes, we're taking your offer, or they could say, no, we don't want to deal with that. Those are all valid options that could happen when you offer on a house. All right, you got the house. You are going to become a homeowner. There are going to be some costs associated with this. Obviously, we've talked about your mortgage, all that. A few other things that I want you to be prepared for when it comes to the cost of owning a home. Mortgage is going to be your biggest line item. The next thing is home insurance. Now, I just saw an article recently within the last month that said the average person pays about $400 a month in home insurance. Now that's average. You're probably buying a house that's a little bit less expensive. It's probably going to be lower than that, but that's something you'll have to figure out with your insurance company. And so I would say it's better to budget for $400 and then it be less than budget for $200 and it be more. So that's just what has been in the news recently, is that the average person in our area pays about $400 per month. The other thing you will have are taxes, property taxes, that will range from town to town and municipality to municipality. I can't really give you a ballpark on that, but it'll be a few $100s a month. You can pay that bi-monthly. There's all different ways that you can pay it. You can pay it with your mortgage. They can lump that in. But that's another one, is your insurance, or sorry, your taxes, mortgage, insurance, taxes, and then maintenance. If you can, 1% to 2% of the cost of the home, if you could put that aside every year to just pay for things as they come up, or the big things that will eventually come up, like we talked about, the roof, the HVAC system, windows, those kinds of things. If you can put that money aside and just have a little nest egg there for maintenance, 1 to 2% of the price of the house, that's going to help you pay for those capital expenditures when they do come up. Utilities are another cost. You're going to want to ask the listing agent. They might have a copy of all the utility costs that the current owner is paying, so that will help you budget in that way. Again, it'll probably be $300-400 at least for that every month, so that's something you want to budget for. And then if you live in a condo, you're going to have, if you buy a townhouse in our area, there's some that have home association fees or condo fees. That's going to be included as well. That'll be on the listing, so that'll be another cost that you're going to have to get ready for. So those are some expenses that you will have when you own your home. Closing costs are a different thing. So this is where you need a little bit more money than just your down payment to buy a house. Closing costs will include things like, one is an inspection. If you have that condition for an inspection, this isn't quite closing, but this is a fee that happens within the offer process. I would budget up to $500 for that. I've seen them anywhere between $350 and $500 in our area. So I would budget for that. If it's less, great, money back to you. If not, then you've got the money there for it. So inspection, I would budget up to $500 for in our area. You're gonna have adjustments. Adjustment is basically this. Let's say you buy a house and you take possession July 1, and the current homeowners have paid their property taxes for the year. You are going to have to pay back that seller the property taxes for those last 6 months because they're not living there for those 6 months. You are, so you're paying the property taxes instead of them. So whatever that adjustment. Now, typically you don't see homeowners paying 6 months worth of taxes. You're probably this is only going to be a few $100s likely. Taxes, hot water tank rentals, those are the things that I see the most that come in for adjustments. But that's where I would just be aware that at closing, there's going to be an adjusted price in there somewhere for either taxes or any kind of rental equipment that's in the house. Those are the typical ones that pop up. Land transfer tax, now that's kind of a sliding scale. As a first-time home buyer, you do get a $4,000 rebate on it. So the first $4,000 of that you don't have to pay. If we're using the example of the $650,000 house where you're putting $40,000 down that I talked about before, then you're going to pay just under $5,500. So $5,475 is going to be the cost on that. But there are mortgage calculators and land transfer tax calculators. I have one in the description of this video. You can go link to that and it can calculate that for you based on what your budget is, so you know what that cost will be and have money set aside for that as well. Last thing you'll need money for is a lawyer. Again, I would budget up to about $2,000 for this. Typically, I think it's going to be a little bit less, but again, I would rather tell you a little bit higher and then you have the money, then you get to the end and you can't afford your lawyer. So budget for that as well. You're going to need a lawyer to close on your house, and that is the last step you're going to need in dealing with all this. That's the last person you're probably going to see to sign everything over and potentially maybe even get your keys from them. So have that money set aside for a lawyer as well, and that will now any other moving costs, if you need movers, if you need someone to help carry your stuff, that kind of stuff, that's going to be a little bit more. You want somebody to go in and clean the house first. That could be, budget for those things if you would like as well, but that's completely up to you. But those are typical closing costs that you'll see with a house. So that's everything. You've got your house, you've got the keys, you've got your map. Hopefully this is helpful for you. And like I said, if you have any questions, my email is in the description below. Reach out anytime and I will answer every one of those emails.